Hey guys, this is James and I am back with video 22 in this series. Today we are looking at SPYD, which is SPDR's portfolio S&P 500 high dividend ETF. So they're calling this an S&P 500 ETF, but they're only choosing the high dividend paying companies out of the S&P 500. So what are we going to do in this video if this is the first time you've seen this series? So we take an ETF and we're on our 22nd ETF. We go over to their webpage and try to determine what they are doing to be able to pay us a dividend. How are they reaching those dividend yield numbers? Then we head over to Seeking Alpha and try to determine an average historical yield on their daily dividend yield chart, and then choose that number, bring it over to our compound interest analysis calculator, and try to determine how much of SPYD we need to own to hit $1,000 a month in dividends. Hopefully you guys are enjoying this series so far. It's coming to a close here very soon. To round out the video, we're going to take SPYD and compare it to SPY, or an S&P 500 index ETF. So let's get started with SPYD. Over on State Street's website, SPDR portfolio S&P 500 high dividend ETF, ticker symbol SPYD. So what does that mean? Well, it means that this index, or the index that SPYD is tracking, it's designed to measure the performance of the top 80 high dividend yielding companies within the S&P 500. So as far as I could tell, there was no options being utilized or no options strategy to be able to pay you the income or pay you the dividend yield. They are simply buying the stocks, the top 80 high dividend yielding companies within the S&P 500 index, and they are charging you 0.07% for this. So that's around $70 a year for every $10,000 that you have of SPYD. So let's take a look at some of the top companies here in SPYD. We're going to do that over here on Seeking Alpha. So down here is their top 10 holdings, some familiar names, some familiar energy companies like Exxon, Chevron, and the top holding is Cardinal Health, and then you have other holdings such as this. So a total of 83 holdings according to Seeking Alpha, but they do have some type of cash holdings in there that they would probably reinvest into the stocks that they own, which would account for some of the holdings. And just taking a peek at the sectors breakdowns, they have financials, utilities, and real estate being the top three, and the top three being close to about 50 to 60% of the fund. So let's take a look at their dividend. If we click on dividends tab, click sub tab dividend yield, you can see that not taking out the account of the stock market crash all sudden in March of 2020, you take that out where artificially inflated the dividend yield. They were hovering around 4% dividend yield all the way up to about a 5%. So 4 to 5% can be our expectation for SPYD. Now you see that there was this sudden drop here. So what is that sudden drop? What happened? Let's go take a look at their dividend history and see what the payouts look like. So in the 5-year history, we can see that 3 to 5 years ago, they're paying fairly consistent, with the lowest being about 26 cents per quarterly payout all the way up to about 50 cents. Then they had a few high payouts, and then it looks like they dropped back down to that 40 cents range. And then December of last year, they only paid a 13-cent dividend, followed by the highest dividend they'd paid in the past 5 years at 65 cents. So that looks like where we got our drop off from that 5% dividend yield down to 4% dividend yield. And in the past 2 quarters, we've had around that 40 cents dividend yield. So for our calculation, let's go ahead and use 4.5% for our dividend yield. I feel like that would be fair enough. If we take a look at this chart, 4.5% would be a fair number for SPYD. So over on our calculator, we have SPYD, And then we come down here and we can change 4.5% being our dividend yield number. And then if we wanted to, we can put in the expense ratio. That's what they're charging us to put this ETF together. And down here we have growth and contributions numbers that we could play around with the annual growth rate, play around with how much money we'd want to put in our portfolio one. And in this case, our portfolio one is simply SPYD. We can compare it to another S&P 500 ETF as SPY, but we're not going to focus too much on the growth and contribution in this video. If you change these numbers around, you can also see what type of portfolio you'd have over the course of the next 10 years and what type of income you could be receiving over the course of the next 10 years. But down here is what we are looking at for the purpose of this video. For SPYD with a 4.5% dividend yield, we would need around $270,000 of SPYD to hit $1,000 a month and around 1.3 million to hit $5,000 a month. So let's take SPYD and see how it has compared against SPY. We'll do that over here on Portfolio Visualizer. We started with a balance of $500,000, just artificial $500,000 starting at the inception date of the newest fund, which would be SPYD. So that'd be around October of 2015. So if you invested $500,000 October 2015 in both the SPY and SPYD, in this time frame, SPY would have outperformed SPYD, SPY being the red and blue being SPYD. So the final balances would be as seen right here on the screen: $897,000 for SPYD and $1 million for SPY. That gives us about a 11.8% growth per year for SPY and about a 9% growth per year for SPYD. So you can see that in the past about 7 years or so, SPY has outperformed SPYD. But I wanted to show you something here. In the last year and a half or two, if you just take this analysis and go from January of 2021 to today, September of 2022, you can see that a fund like SPYD that pays a fairly decent dividend yield compared to an S&P 500 fund, SPYD will outperform SPY in a period that the market is actually flat or going down. You can see starting January of 22 that SPY has continued to drop, but SPYD has been fairly flat over the course of 2022. Why is that? Well, SPYD is owning companies that have a fairly decent economic moat, that in a time period like this, the companies are very well established and they have a product or offering that is needed in a time like this. If you recall, over on the holdings tab for SPYD, there wasn't much tech involved. Technology sector was only about 5% of SPYD, where most S&P 500 funds, it's somewhere between 10 to 20%. So in a time period like this, not many people are investing in those high growth type of funds in the tech sector, and they're more focused on blue chip high dividend yielding companies. And you can see that here in this graph right here, where SPYD outperforms SPY in this time period. So let's see what just the year of 2022 would have given us. January of 2022 until the most recent time period, which is September 2022. Taking a look at that, I just wanted to see what the actual overall returns would be. So if you invested $500,000 in December of 2021, let's say you retired at the end of last year, you had $500,000. Well, your final balance in SPYD is $490,000 with a total return of negative 2%. Now this is with dividends reinvested, and SPY is $500,000 starting balance and $420,000 as a final balance after 9 months this year, with a total return of a negative 16%. So let's see, if you were to pay yourself, let's say you were not to reinvest the dividends, analyze the portfolio, pulling those dividends out Your SPYD final balance here for the 9 months of this year would be $478,000, a 4% loss this year, and SPYD would be $416,000 and negative 17% loss this year. Let's check out your income that you would have received, that you would be paying yourself. For SPYD, you would have received $12,500 this year, and for SPY around $3,000 in dividends. So that concludes SPYD versus SPY. Let me know what you thought of this video, and if there's another ETF you want to see analyzed in this way that you don't see on this list, head down into the comments and let me know. If you want to play around with this calculator, it is offered over on Patreon. And with that, thanks for watching.